Most people are taught to think of the global economy as messy, unpredictable, even chaotic. Markets go up, markets go down, crises appear out of nowhere, and policymakers scramble to react. That story is comforting because it suggests no one is really in control. But history tells a very different story. When you zoom out far enough, the global financial system follows patterns that are remarkably consistent. So consistent, in fact, that the rise and fall of economic powers over the last 3 centuries looks less like chance and more like a repeating mechanism. Right now, we're living through one of those transitions. The headlines focus on trade wars, sanctions, reshoring, and political tension between Washington and Beijing. But beneath that noise, a deeper shift is underway. The global dollar-centered system is weakening, and China's financial gravity is growing. This isn't happening randomly, and it isn't happening suddenly. It's the latest turn of a cycle that has played out again and again, quietly transferring power from one dominant currency to the next. To understand where we are and where this is heading, we need to understand how this cycle works. At the core of every global monetary order is the same 4-stage process. It has ended every reserve currency in recorded history, regardless of culture, ideology, or technology. The first stage begins with a monopoly over money creation. A central authority, usually a central bank, gains exclusive control over issuing currency and credit. On the surface, this is presented as a stabilizing force, a way to smooth out economic shocks and finance public needs. In practice, it creates an extraordinary concentration of power. Once money can be created at will and lent to governments, the constraints that once limited spending quietly disappear. Britain provides the classic example. In 1694, exhausted by war and short on funds, the British government allowed the creation of the Bank of England. In exchange for a loan, the bank gained the authority to issue money backed by government debt. What followed was revolutionary. Debt became money, money circulated widely, and those closest to the system collected interest on the entire supply. Within a few years, Britain's national debt exploded, but so did its global reach. The pound sterling became the backbone of international trade. The second stage is debt-fueled expansion. With money creation centralized and credit abundant, governments spend freely. Empires grow, infrastructure expands, military power strengthens, and living standards rise. Confidence builds, and people begin to believe the system is permanent. Britain's navy ruled the seas. Its currency settled global trade. For decades, it worked beautifully. This is where many people assume the story ends. But it never does. The third stage arrives slowly and quietly. The costs of maintaining dominance begin to exceed the nation's productive capacity. Debt grows faster than real output. The currency loses purchasing power. Financial engineering replaces real growth. At this point, leaders often insist that minor reforms or new policies will restore balance. They never do. By the mid-19th century, Britain was falling behind industrial competitors like Germany and the United States. The empire was expensive to maintain, and its industrial edge was fading. The system was still standing, but cracks were everywhere. The fourth stage is the most important and the least understood. Before the decline becomes obvious to the public, capital begins to move. The same financial elites who benefited from building the old system quietly shift their wealth into the next rising power. The population is left holding a currency that continues to lose value, while the foundations of the next system are already being laid elsewhere. This is exactly what happened as Britain declined. British capital flowed into American railroads, factories, and infrastructure. By the time the pound officially lost reserve status, financial power had already relocated to New York. If this sounds familiar, it should. Germany's experience after World War I offers a more extreme but equally revealing example. Crushed by reparations and political instability, the Weimar government turned to the printing press. The Reichsbank monetized debt at an unprecedented scale. The result was hyperinflation that destroyed savings and wiped out the middle class. By 1923, prices were changing by the hour. This catastrophe is often portrayed as incompetence or desperation. In reality, it served a purpose: domestic debts were erased, social structures were reset, and at the height of the crisis, foreign capital, especially American, flowed in to restructure German industry. When the system later collapsed politically, much of that foreign capital had already exited. Then came Bretton Woods. In 1944, as World War II neared its end, a new monetary order was designed. The US dollar was pegged to gold, and every other major currency was pegged to the dollar. With unmatched industrial strength and massive gold reserves, the United States became the center of global finance. For decades, the system delivered stability and growth. Europe rebuilt, Japan rose, the dollar ruled. But the cycle didn't stop. The US began funding wars, social programs, and global military commitments through deficits rather than taxation. Dollars flooded the world. By the late 1960s, foreign claims on US gold far exceeded what America actually held. When countries like France began demanding gold instead of dollars, the system broke. In 1971, the gold window was closed, and the dollar became a purely fiat currency. Since then, the dollar has lost the vast majority of its purchasing power. Debt exploded. Financialization replaced production. The pattern repeated. If you're finding this analysis useful so far, take a moment to like the video and share it with someone who cares about where the global economy is heading. These long-term patterns are rarely discussed, but they affect all of us. Now we arrive at the present moment. Publicly, we're told the United States and China are locked in a bitter economic struggle. Tariffs, technology bans, and talk of decoupling dominate the conversation. But beneath the surface, something very different is happening. While trade war rhetoric filled the news, the world's largest financial institutions were moving massive amounts of capital into China. Index providers like MSCI began integrating Chinese assets into global benchmarks, forcing pension funds, insurance companies, and sovereign wealth funds to follow. Trillions of dollars didn't drift into China by accident. They were directed there by institutional design. This is stage 4 in action. Just as British capital built America and American capital restructured Germany, global financial elites are positioning themselves inside China's economy. Political tension provides cover. The public argues about tariffs, while capital quietly builds the next center of gravity. If you disagree, or if you see signs that confirm this shift, share your perspective in the comments. These transitions affect different regions and industries in different ways, and hearing multiple viewpoints makes the discussion stronger. Meanwhile, the numbers inside the US system tell a clear story. National debt continues to climb. The Federal Reserve's balance sheet remains bloated. Deficits are structural, not temporary. Money creation far outpaces productive growth. This isn't the result of a single administration or policy mistake. It's the mechanical outcome of a debt-based system reaching its limits. What makes this moment especially dangerous is the insistence that this time is different. We hear that technology will save us, that modern finance has solved old problems, that central banks can manage outcomes indefinitely. History offers no evidence for that optimism. The mechanism doesn't care about ideology. When money creation detaches from real value creation, debasement follows. Always. For everyday people, the consequences aren't abstract. Inflation erodes savings. Fixed incomes lose purchasing power. Assets tied solely to weakening currencies quietly transfer value elsewhere. By the time the shift becomes obvious, repositioning is already complete. This doesn't mean collapse happens overnight. These transitions unfold over years, but they are already in motion. The real divide is not between nations, but between those who recognize the pattern and those who don't. Understanding this cycle doesn't mean you can stop it. It means you can stop being surprised by it. It means recognizing political theater for what it is, a distraction from structural change. It means watching capital flows instead of headlines, and incentives instead of speeches. The next decade will look very different from the last. Debt will not be worked off. Currency pressure will not magically reverse. And financial power will continue shifting toward where capital feels safest and most productive. History doesn't repeat because people fail to learn. It repeats because the structure rewards the same behavior every time. The global dollar system isn't collapsing tomorrow, but it is declining. China isn't replacing the US overnight, but it is absorbing capital steadily. And the transition will only seem sudden to those who weren't paying attention. If you found value in this breakdown, make sure to like the video, subscribe to the channel, and turn on the notification bell so you don't miss future deep dives into global finance and power shifts. Thanks for watching, and I'll see you in the next one.